Now, if you look at the market participants in the secondary market, first is the investor. Investors are people who buy stocks and hold them for long period of time, maybe days or sometimes many years. People have purchased in 1995, 96, 91, still they are holding that stock. They might have purchased at 10 rupees. Now it might be like 3,000, or even some stocks are at 50,000, 60,000 also. Those are long-term investors. So you put money in that stock, you purchase the stock and you just hold it. Now every year they pay dividend. You take that dividend, which is tax-free, and it grows. Whenever you require funds, you could sell that in the secondary market and you take the benefit of the price increase. So you purchased at 10, now it is at 100. So you make that money there. And the second participants are traders. Trader may enter and exit a position within seconds. He enters now, he exits immediate, benefiting maybe small amount, but with a large quantity. Right? Even if he gains 10 NP in one, but because his investment is more, so he may make 1,000, 2,000 rupees within seconds, maybe within 10 minutes, 15 minutes, a day, like that. Different. So the traders are people who buy and sell stocks. The main purpose is to benefit from the up and down in the market. And similarly, speculators are there. Speculators are very sophisticated investors or traders who purchase assets for short period of time and employ strategies in order to profit. So there are people who employ different strategies, different statistical calculations they do, and they speculate. Okay, the price of this stock will be at so and so price in next maybe 2 days, maybe 15 days. So they do those calculations and they speculate and they take the trades. So the speculators are also the traders who do, but for a longer period, little longer than seconds, couple of seconds kind of thing. And the fourth people are hedgers. Now, who are these hedgers? For example, you have 10 lakhs cash. So you have purchased some stocks, different company stocks you have purchased. Now, due to Corona, like for example, stock market started falling because, yeah, obvious reasons. Now, what happens when you invested 10 lakhs, it went to 12 lakhs. And after the Corona lockdown, it started falling. Now it has come to again 11 lakhs, 10 lakhs. Now it has gone to 9 lakhs. Like that, it might have gone to 5 lakhs also because 50% it has come down. So how do you mitigate that? How do you protect your portfolio? For that purpose, there is a concept called as hedging. For example, when you know that stock prices are falling, what you do, you exit that, right? You exit and whatever gains you are getting, you take that. But exiting and again entering will cost you money because they charge when you buy and sell, they charge. Tax component would be there. Like that, you cannot buy and sell on a day-to-day basis. So instead of selling, they do the hedging, right? Instead of selling that stock, they sell some other thing, some other instrument. So if your portfolio is coming from 12 lakhs to 8 lakhs, because you sold something else and you gain from that, and your portfolio is protected. You may lose 4 lakhs in your portfolio, but you may gain 2 to 3 lakhs in some other instrument. So that's how the hedging works. That's an advanced concept. We may look at it in a different session. But if you're looking at market participants, one is the investors who put money in stocks and hold for longer period. And there are traders who do in microseconds. And there are speculators who, based on some statistical calculation, based on their own theory, they use a lot of technical indicators and they take trades for maybe a couple of days or maybe more than 10, 15 days, sometimes 3, 4 months also. And the other one is hedger. Now, who are the other market participants or the stakeholders of the stock market? Now, there are stock brokers. Now, as a individual, you cannot purchase the stocks directly from other user. Right? You might be holding ICICI Bank some 100 shares. I want to purchase 100 shares. I cannot come to you and say, okay, I will give you so much money. You give me those 100 shares. You cannot do that. you need a stock broker in between, because those are the authorized people who can do that. So stockbrokers are the licensed professionals who buy and sell securities on behalf of investors. So you instruct the stockbroker, say, okay, I want to purchase 100, you get me. So what the stockbroker will do is, okay, you want 100, let me see who is selling 100. You will see, okay, this person is selling 100, he will take stock from him and he will give it to you. So that's the job they do. So they are in betweeners, right? They are intermediaries between the stock exchanges and the investors. So there is a stock exchange where people are coming to buy and sell, but you cannot participate directly in the stock exchange. It's like a wholesale market, for example. Stock exchange is like a wholesale market. You cannot purchase 1 kg tomatoes in the wholesale market, right? You have to go to a retail market. There you can purchase 1 kg. In wholesale market, you have to purchase in larger quantity. Similarly, you cannot purchase in the stock exchange. You have to go to a retailer, right? That is the stockbroker. So you go to the stockbroker and say, give me 100 shares, and he will see who is selling, and accordingly, he will take it from him and give it to you. So that's the job of the stockbrokers. Now you might be seeing advertisements of so many stockbrokers on TVs and all, like Zerodha is there, Angel Broking is there, IAFL is there. So many brokers are there. Hundreds of brokers are there who are the intermediaries between the investors and the stock exchanges. Now you need an account with the retail broker to gain access to the markets. So if you want to purchase anything, you need an account with the stockbroker. So you need to open an account with the stockbroker. You can choose which broker you want and you go to their site or register and you open an account. After opening an account, you can transact in your account. You can purchase stocks. You can sell the existing stocks. You can do that. And the second market participants are portfolio managers. Who are they? So portfolio managers are professionals who invest in portfolios. Portfolio means it's a collection of securities, collection of stocks on behalf of clients, right? So these managers get recommendations from analysts. They will have a set of analysts. So they say that, okay, this company is doing good, you can take this one. So the portfolio manager takes a decision, and based on the rules, right, based on the regulatory rules are there, so based on those rules, he will take care of the stocks which need to be purchased, which need to be sold. So mutual fund companies would be there. So the portfolio managers of mutual fund companies or hedge funds or pension plans are there. So all use portfolio managers. Everywhere you will have portfolio manager. You might have taken a pension plan. You put every year some money in that pension plan, or you have taken a mutual fund, you put money in there. So all this money is accumulated at one place and they buy stocks, they buy in different instruments based on the rules. So that is the job of a portfolio manager. And the next one is investment banker. Investment banker represents companies in various capacities. We said the company wanted some funds, he wanted 200 crores, he is diluting 2 crores. But he cannot come directly and talk to investors, right? He cannot come to us and say, okay, you give me 7,500, I will give you shares. He requires some platform, right? So the investment bankers are there who have knowledge of the IPOs, how to place an IPO, everything. So they are the specialist. It is their job to do. So the company goes to an investment banker and says, okay, I want to list my shares. Please help in this. So they do those all regulatory requirements and they take some fee from the company by doing this whole process. So they take care of the listing process in compliance with the regulatory requirements of the stock markets. So those are the investment bankers. And there are custodians and depositories, like NDSL is there, CDSL is there. So CDSL is a short for Central Depository Securities Limited, and NDSL stands for National Security Depository Limited. So what is the role of this custodians is, see, you want to purchase a stock. Okay, you are purchasing. Earlier, stock market used to operate on paper, right? You purchase a stock, you get a piece of paper. On it, it is written as, okay, so many stocks you have purchased, and also there is a stock certificate is there. Now everything is done electronically. Now you purchase 10. Now where that stock will come? It will come to your account. But there are, as I said, hundreds of brokers, stock brokers are there. And you may have multiple accounts with different stock brokers. Now when you purchase, where that will be there? So you need to open an account with NDSL or CDSL. Now that account means it is a safe deposit kind of a locker. It is a locker for your securities. So you need to open a locker. Now when you purchase a stock, the stockbroker will purchase on your behalf and store that in your locker. So the locker is maintained by the custodians. These two different organizations, NDSL and CDSL. So there is a custodian who holds all your shares. So it is like a depot. So they hold the customer securities for safekeeping, and also to minimize the risk of theft and loss also, right? If you are holding, there is a risk of losing or theft is there, but there everything is maintained in a secured place. And also it helps in easy transfer. Suppose today you purchase, tomorrow you sell, simply from your account, it will be transferred to the other account. Similarly, like your bank account, right? In bank, you have money, you just transfer, it will transfer from your bank to the other bank account. Similarly, the shares also transferred from one account to other account. And there is another set of people who are market makers. So these are the people who provide liquidity to the market. Suppose you want to buy a stock. If there are no sellers, where you will buy a stock? So in between, there are certain kind of organizations who are market makers who hold some stock. So whenever somebody is buying, if no one is selling, he will sell from his account. Similarly, someone is selling and no one is buying, so he will buy from his account. So by this, some amount he will make in turn. So those are the people who supply the liquidity, right? So these are the different market participants. To summarize, the market participants are the general public who are either investors or traders. Similarly, there are stockbrokers who acts as an intermediaries between the investors and the stock exchanges. Portfolio managers who manage public's money. The investment bankers are there and custodians. Now, if you look at this infographic, you will understand the whole picture here. Now, there are four pillars to the economy, right? One is the government of India. On the other side, bank is there. And other side, the business people are there, the promoters. And on the other side, there are the common public. So how the scenario play out is, the government proposes policies and it proposes to RBI, right? So, and this RBI prints money and also it controls, regulates and lends money to a bank. Now, what these banks will do is in turn lend money to companies. So there is a promoter who owns this company and he requires funds. So he goes to bank and says, okay, I want some funds to expand, to do business. Bank lends this money. They use, they make profit. In turn, they pay interest. Now, to reduce the burden of interest and all, as we have seen, there are multiple reasons for the company going for listing. So the company says, okay, I want to disinvest or maybe get some funds from the public. So what they do, they approach a merchant banker. So these people are who are experts in filing the listing with the stock exchanges and taking the company to the stock market. So the company will approach them, they will agree to some fees, and these merchant bankers will file in the stock exchanges. After this, it will be listed. So the owners, what they exactly they are doing is they are giving their share. That means the ownership is diluted. Instead of owning the 100% of the company, the 20% they are diluting, right? So now they are only 80% owner of that company. So 20% will be given to general people. So the shares are created. Now the merchant bankers applied this, stock exchanges okayed it, And now in the example, we said that 2 crore shares. So the 2 crore shares have come to the stock exchange. Now what will happen? Now people like you and me have applied for the IPO, right? So our bids are allocated, so we get something. Similarly, HNIs or high network individuals also participate in the market with a huge amounts, maybe 500 crores, 200 crores, like that. And there are institutions like mutual funds are there, LIC is there, pension funds are there. So many people are there, all come to the same marketplace, all buy at the same place. We may buy in hundreds, these people may buy in crores, this may buy in more like 100, 200, 300 crores, right? So the process is same. These people come to this and buy. But for a individual to buy those securities, we require account with the stockbroker. So there are two types of accounts. One is the demat account and another is the trading account. So if you want to purchase a stock and you want to hold it for a longer period of time, then you require a demat account. Okay, demat means dematerialized account. So you open a demat account. You will open a demat account with CDSL and NDSL. So who are the depositories, right? You are opening an account with this one, so you have a account. Similar like bank account, you have a demat account. Now when you ask your stockbroker to purchase some stock, so he on your behalf, he will purchase, and after that purchasing, he will send to your demat account. So that will be stored here. Now, whenever you want to sell it, you will instruct the stockbroker, okay, I want to sell so many quantity at so and so price. Now the stockbroker will have access to your depository and he will sell on your behalf and he will credit money back to your demat account. Now from here, you can withdraw to your bank account. So from your bank account, you are putting money in your demat account. Similarly, you are withdrawing from your demat account. So when you are opening an account with a stockbroker, he will ask for you which bank you are transacting. Now you have to link a bank account. Now you will be able to pay in and pay out from the same bank itself. You cannot do it from others' account. So that's one rule they have come up with. So you have purchased the stock and it is stored here. Now, as I said, there is a controller who is managing all this. There is a SEBI which controls these depositories, which controls the stock exchanges, and it also controls the stockbrokers. So these people control all these institutions. Similarly, as government proposes policy, RBI controls banks. Similarly, SEBI controls all these things. Now, after this, what happens? Now, this is a marketplace. Now, different kinds of people start buying and selling those same stock. Those 2 crore stocks are in the marketplace now. So every day someone will need money, he will sell. Every day someone wants to invest money, he will come to the market. And when you are buying, you don't know who has sold it because you are not directly dealing with that other person. There is a stockbroker in between. So you just place, I want to purchase 100 quantity at so and so rate. So whoever is selling that, whoever is selling, they will sell that so many quantity. Sometimes what happens, you are placing order for 100. Some other person is selling only 3. So you will get from 3. Some other person may sell 50. So you get 50 from the other one. So whatever may be reason, you will get your 100 stocks. If you have any queries, you can ask me now.
Hello?
Yeah.
The stockbrokers, how do they get their money? Like banks, staff get salary, right?
Yeah.
So how do stockbrokers earn in this?
Okay. See, the stockbrokers on your behalf, he is purchasing and selling, right? So he
Yeah.
will charge some money.
Okay.
Okay. So he will take some money. For example, now if you look at the stockbrokers, there are two different kinds of stockbrokers. One is the full broker, another is the discount broker. Now earlier when you used to purchase anything, they used to charge at percentage terms. Like for example, if I purchase, they will charge so and so percentage of amount they will charge to us. So
Okay.
if I purchase 1 lakh, I may have to pay 100, 200 rupees. But now the discount brokers have come in last 10 years where they will charge only a fixed amount. For example, 20 rupees. How much quantity you purchase? 100 crores also you purchase, they will charge only 20 rupees. Even if you purchase 100 rupees worth also they will charge 20 rupees only. So they are called the discount brokers. So that's how they make money. But this is not the only way they make money. There are other avenues for them to make money also, but they are profitable setups. And for example, you are not able to do the transaction, you don't have time to do. So what you do is you call the stock broker and say, please purchase 100 quantity of so and so in my account. So on your behalf, he will place the order and he will get to you. So in doing the service, he will charge some amount.
Okay.
Right. So in this way, they earn money in different ways. Couple of ways we have discussed, but they have their other avenues.
The preferential shares which you're saying, just one line more about that.
Okay. See, when the company wants funds, he will come through the primary market, that is the IPOs.
Yeah.
Now, after issuing the IPO, again he wants money, he can come through different ways. One is the rights issue, which I told, means you can get money from the existing customer. Like recently, Reliance has issued rights issue. Okay. So they said that, okay, the people who already owners of the Reliance shares, they can purchase at a discounted price and they had to pay only 20%. Now, next year they have to pay so much, like that. There are certain rules for that they have issued. Now, the preferential allotment is, suppose you already know some people who want to invest. They have come to the company and said, we want to invest. Like, for example, SoftBank is there. Today morning itself, they have put some money in the Swiggy, like Zomato, Paytm, right? So private investors put money in those companies.
Okay.
So
So like angel
angel,
marketing or
right.
something
So
similar.
similar to that. So it's a private placements or preferential allotment. They are only allocating based on certain preference. They are allotting to that.
Thank you.
Yeah.
Sir, can we have more than one demat account?
With one PAN number, we can have only one account.
Means if I am registered with one broker, suppose Angel, and then I want to have one more account in Zerodha, then
You can
can I?
see, you can have, but at the depository level, you will have only one account.
Okay, means
Means
can I
when you
have
open a, see when you open a account at NSDL or CDSL, he will ask your PAN number. Right. So with
Okay,
one PAN number, you can open one depository account. Now you can use hundreds of brokers, but whenever you purchase, everything will come into that one account.
okay.
Right. If you want to
So
open a new account, then you need to have a different PAN number, which is
deep,
not possible as an individual. You cannot
that's
have two PAN
not
numbers as an
possible.
individual. Then you have to open on your family member's name.
So in short, you want to say that if I open with one broker, then I can't go to some other broker simultaneously.
No, if you already have an account, they will link that account. That broker also will link the same account of yours. Because when you enter PAN number, automatically it will be linked.
Okay. And both of them will have details of each other, like how much I am dealing in
No, no,
that.
they won't have, because they can only deposit securities and request for transfer. Right. When you purchasing, they will send that instruction to the depository. Okay, this person has purchased. You put that in your account. Yes, it will be there. And when you sold, they will send that, okay, this person has sold, give me that from his account. I need to give it to some others. Yeah. So that process will be done. Now, how an individual can participate in the market? As we have discussed earlier, there are two ways. One is investing and the second one is trading. What do I mean by investing? See, investor seeks larger profits over an extended period through buying and holding it. Okay. So investors seek larger profits or larger returns over an extended period through buying and holding. But in contrast, the traders take advantage of both rising and falling markets to enter and exit positions over a short period of time or shorter time frame, taking smaller profits but more frequent profits. So there is a difference. Investment is you put money and you put invested for a longer period, and whenever you get a decent profit, you exit. But as a trader, it is a shorter period. You take it. It may last a second or it may last a couple of days, maybe less than 50 days or something like that. But both are participating with a goal, that is to attempting to profit in stock market. So the goal is same, is you are making money, you are earning money from the stock market, but approaches are different. So if you know what is investing and what is trading, then you can choose whether you want to be an investor or whether you want to do trading. Now let's see the difference between the investment and trading. As I said, it's a long-term approach, and trading is a short-term approach. In investing, you could benefit from rising market only. For example, you purchase a stock and you can benefit when the stock price goes up. When the company is doing good, the stock price goes up. So that's where you make money. But in trading, we can benefit by both ways, in the rising market, also in the falling market. That means when the market is falling, you could sell it. Even though if you don't have that stock, you can sell it. For example, today some company has come out with the results. So those are bad results. So you know that the stock price will come down. So what you do, you sell that stock. Even though you don't have it, you sell it. And when the price comes down, you purchase it. For example, now it is at 100 rupees. You sell at 100 rupees. When it comes to 80 rupees, you buy it. Net, you are making profit. You should understand the two different things. One is you purchase at 100 rupees. When it goes to 120, you sell it, you are making profit. So there is another way of profiting also. You sell it at 100. When it comes below that, you buy back, right? Then you are making profit. There are two ways of benefiting. So in trading, you can do this both ways. But in investing, there is only one way. You invest, and if it goes up, you are making money. If it comes down, you cannot do anything about it. You are losing money. That's the basic difference. In investing, you are looking for a larger returns, but less frequent rates. You put money, and if it doubles, you exit, or if it gives you 15%, 20%, depending upon your calculations, you exit. But in trading, you are looking at a smaller returns, but more frequent returns. Maybe every day you do. You earn 1,000 rupees a day. At the end of month, you get 25,000 rupees. Right. But in investment, you put money, you invest 1 lakh, and maybe sometime you will get the 25,000. So different approaches. In investment is a less risky one, because you have chance to exit your position, because it's an investment, right? You are not putting whole in one thing, right? So you purchase some stock, you may purchase like 1 lakh worth stocks you purchase, and you have purchased at 500 rupees. Now it went to 600. Now you can put a stop loss. That means if that is coming below this, I can exit that trade. Okay, you will say 550, it comes below, I will exit. Till that time, I will be holding. So whenever that 550 comes, you exit, and it's like a slow movement. So you can do that. But in trading, you are taking risk here, because you are putting more money here. Like for example, there, instead of purchasing 100 stock, here you are doing with 10,000 stock. The same thing, you are doing 10,000, because you are looking for small 20 NP profit. 10,000 you have invested, 20 NP profit, you are making 20,000. Fine. That's good, right? But imagine if it moves 1 rupee down, then you are losing 1 lakh within seconds. So there is a higher risk in trading, because you are trading with a higher quantity. That's the risk there. And you get tax benefits in investing. So if you are holding a stock for 1 year, after that you sell, there is no tax for that. Before that will be taxed at 10% as a capital gains. But after 1 year, if you are selling, whatever it is not taxed. But in trading, the income is taxed as a business income. So whatever you earn, depending upon your slab, you may have to pay 30% of that. So that is the difference between investing and trading. And for investing, you need a demat account. And for trading, you require a trading account. So when you open an account with a broker, You can open both at a time, right? Single account, they will allow both. Or you can open only trading account. So when you open a trading account, you cannot purchase stocks and hold in that. So while opening an account with a broker, you need to see what kind of account you are opening, either demat plus trading or only trading or only demat. Like that, you need to select.